Twilio stock is down over 50% from its high last year, and investors are wondering, bottom fishers are saying, hey, is the bottom potentially in? While other growth investors are saying, hey man, this is a lot of pain. How much further can it go down, and should I potentially double my bet on this? I personally, in researching Twilio, I'm very impressed by their value proposition. I think they're increasingly becoming either a very strong value proposition or potentially even unrivaled. We'll talk about that and more in this video. If this is your first time tuning in, my name is Daniel, and you're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and at the time of this video publication, I did not own stock in Twilio, though I am watching it closely. So Twilio runs the leading cloud communication platform. What's this mean? They provide the critical software, in this case APIs, that enable businesses to connect with their customers. In an area where businesses want to own their customer relationships, they need to meet the customer wherever is convenient for them. In Twilio's channel APIs, so this is where Twilio's channel APIs really shine, as they enable the core functionality like text messaging, real-time video chat, email, and voice messaging that enables any sort of direct-to-consumer business to be able to reach out and connect with the end customer. They also provide many different tools that can both streamline and coordinate workforce operations. These include, for example, instant notifications. For example, you have an emergency alert or a delivery notification or some sort of loyalty reminder. Hey, now's your time to get in, this deal. All can be on, like, for example, a text message instant notification, as well as user verification, like two-factor authentication. So it's going beyond just straight up communication tools, but also going into effectively streamlining operations. Not surprisingly, demand for their services has been explosive in the last few years. In the most recent quarter, their revenue growth was 65%, including acquisitions, and 38% on an organic growth basis, meaning excluding acquisitions. This is largely driven by their predominantly usage-based business model. For example, how many texts, emails, how long was a video chat or voice chat, and that usage-based model is about 72% of their revenue. This is reflective of second quarter 2020, but more recently it's around 72%. And this usage-based model further translates into a very attractive dollar-based net expansion rate of 130%. So this, i.e., that means this business would grow 30% plus without adding any new customers based on the increased usage of their legacy customer base. So no new customers and still growing at 30% plus. And you can see it's been like that for some time now. And while this chart's a little bit stale as it's from their 2020 Investor Day, this chart shows Twilio's core revenue drivers over time, the chief being messaging and voice, really enabling merchants to easily connect with their customers via either text messaging or voice. You see the additional services over time as well, while ultimately moving into higher margin services like email functionality and basic app, like the streamlining that I mentioned earlier. And you could see how text messaging has become a smaller percentage of their business over time as they've diversified into other services. And part of that diversification has been from the fact that not only do they have these hyper growth tailwinds that are organic growth tailwinds, I'd argue, but management has also expertly increased their value proposition with M&A, where they're looking to expand their platform and look at tuck-in acquisitions that sort of round out their communication cloud offering. And while any one of their products might have several competitors, and I'd argue they do, I suspect that by becoming the default engagement cloud, where it enables businesses to easily reach out to their end customers or create these workflows, and bundling their services, where you'll have businesses that say, oh yeah, I want text message, I want voice, I want email, I want chat, I want Facebook Messenger, I want to roll all this up, I want a customer data platform that easily looks at all this data and, just starts to figure out, okay, what's appropriate for which different customer. I want, effectively my chat bots, I want authentication. When you start thinking about this as a bundled function, then you could probably, effectively have better pricing on that and ultimately become even more competitive, making you even stickier. The fact that they have 130% net dollar retention does suggest that they do have a very strong stickiness aspect, suggesting a competitive advantage. So layer in all these different functionalities, a broad set, increasing sort of this brand awareness, I think it does increase the odds that they have some competitive advantages that make them unrivaled in the years ahead, that will make it easier for them to grow in this very large $80 billion market that they're looking at. Okay, so what about the valuation? Because, any great company can be a poor investment at the wrong price. So a quick plug, if you're interested in joining a community of fellow investors looking to learn and find exceptional companies, we have an exclusive community on Discord. You can sign up at unrivaledinvesting.com, click join the journey. I also call out potential multi-baggers and share my own personal portfolio for those interested. So during their 2020 Investor Day, management penciled out their long-term model of 20% plus operating margins and 30% plus annualized organic growth through 2024. They've obviously done better than that in 2021 with 60% plus growth. These margins are a little lower than, let's say, a pure SaaS business, partly because a good chunk of their cost of sales is tied to the network service providers that enable their communication tools, such as text messaging and voice. So that is part of the reason why structurally they will have a lower margin. And because of that, you should think they will have lower valuation as well over time. Now, they're nowhere near those margins now of 20% plus. They're significantly unprofitable. Free cash flow is a bit better, however, but that's largely due to a huge stock-based compensation expense. So management also isn't afraid to issue stock. So not only do you have significant stock-based compensation, but management will also dilute shareholders, given they have been very active in the M&A space, as I already mentioned earlier, whether or not it's to expand their platform with really key functionality or basic tuck-in acquisition. I mean, you can see that through, for example, comparing year over year, their stock was, their share count was up about 20% year over year. So that is significant, and that does eat into what you should think of as their revenue per share. Now, one should also recognize that while the stock is sold off, it's still significantly above its valuation multiples, let's say pre-COVID, of say 6 to 10 times last 12 months price to sales. And this is the part that I think investors should really be thinking about, because the multiple really got high in the stratosphere, is around 40 times. And now it's down a bit. Now it's down over 50% the stock, and they've grown significantly, and that's part of the reason why the multiple now does seem a little bit more compelling. But the reality is, if you look at pre-COVID eras like 2018, like 2017, you're looking at a stock that traded at 6 to 10 times sales, and arguably it was easier for them to grow faster because you were looking at a smaller base business. Now you're much bigger, and so I'd argue, lower multiples might be more appropriate, just given that, the smaller you are, the easier it is to scale. Now, could they continue with hypergrowth in the years ahead? I certainly do think so. But I think generally, the smaller you are, the easier it is to post hypergrowth figures. And so it is a cautionary tale, I think, to reflect on the fact that this traded as low as 6 times the last 12 month sales, and relative to where it is today, that would represent a huge discount. Now, you could counter argue and say, well, maybe the stock was very cheap clearly here, and maybe a better bottom might be around 8 to 10 times sales. So either way, that is something for investors to consider, that you're still not out of the woods, I'd argue, from a valuation standpoint. So as I consider Twilio for the years ahead, I have a few thoughts. One, given their very strong competitive position and huge addressable market, $80 billion plus, I expect strong growth in the years ahead for them. Given that they're still significantly unprofitable, I'd expect the stock to be wildly volatile. Sentiment in any given year will be one of the biggest drivers of their performance. So not only is it the fundamentals, but sentiment is going to play a key role. And this is because that you have such large assumptions around their operating margins. Currently, here it is. I'm assuming 20 to 25% optimized margins long term. Management says, hey, 20% plus. Currently, they're closer to negative 30%. That's a big difference. And so you want to think about, what will these margins really look like longer term? And that fluctuation between what the market expects in a few years from now versus what they deliver today can cause quite a bit of volatility. If the market gives them credit for where their margins can be in the future, then the stock can have significant upside potential from here. Maybe 200% plus. Maybe around 200%. But if management doesn't deliver and they don't start actually scaling their business, you start seeing real operating profit, or they use a lot of stock for, let's say, additional merger and acquisition activity, M&A activity, then expect further penalties for the stock. Expect sort of continued re-rating, lower valuation. The reality, however, and this is my key concern with companies like Twilio and many other growth stocks, is that pre-COVID, it was not uncommon for stocks that haven't yet proven their operating leverage, that haven't yet proven their profitability, to trade at a discount and not get full credit. And this is complete opposite of the current investment environment, where many of these businesses are given full credit. Of course, this is only a hypothetical framework, where the stock price can go much higher or lower. If they do not deliver, I would expect way lower than what I'm penciling out here. But if they do deliver, you can easily pencil out, let's say 200%, maybe even more. I'm saying 40% annualized. Clearly, they're growing faster than that this year. Overall, I'm quite impressed looking at Twilio. I think management's playing a really smart game. I, enjoy reading their updates. Clearly very thoughtful, building out their value proposition. I think they're potentially unrivaled given their bundle of solutions. The question is the valuation still too rich despite the 50% sale? I'd argue, you look at some of these growth investors, if the market changes its mind and says we give full credit to those future margins, then the stock can do really well. If you're going through a period where the market goes, I want to actually see real profits coming in, then you might be in for a tougher time. I'd love to hear your thoughts, so please make a point of leaving a comment. And if you are already, if you're already a subscriber, I do appreciate that thumbs up. And if you haven't subscribed, please make a point of hitting that subscribe button. Thanks so much for tuning in.